again. Welcome to our afternoon session, and I'm super, super honored. I'm really delighted to have this wonderful session discussing Professor Hal Scott's book. So Hal really needs no introduction. He is an Nomura Professor of Financial Regulation at Harvard. He's the director of the CCMR. He is a force of nature in the field of financial regulation, as someone who has, for many of us, really set the subject as a subject, as a sort of for us to do and to study as a discipline in itself. One thing that I would note about Hal is that I think he should really have his own sort of Netflix superhero series. I have never met someone with so much energy, who is really just a complete force in academia and policy and think tanking and everything. Everywhere you go, he's there. He's written something, so he really is a tremendous force here. So we are going to discuss his book. Then we'll have comments from Kate, Morgan, Sally, and Chris. And I'll introduce each of the speakers as they come. But Hal's going to give a first presentation of his brand new book on systemic risk and interconnectedness.
Thank you. Yes, a former student who
Yes.
I very much enjoyed having. The talk is about connectedness and contagion, and I'm going to focus on that part of the book that deals with lender of last resort. There are a lot of other subjects here, short-term funding, what deposit insurance did and so forth, but I don't have time to really go over that. So I'm going to focus on lender of last resort. So I want to start with kind of the foundation for the book, which is how to think about systemic risk itself, which is at the heart of the rationale for regulation of the financial system. The main point of the financial system is to prevent systemic risk, and I classify systemic risk into three categories, what I call the three C's: correlation, connectedness, and contagion. And correlation, by the way, there's overlap between these categories. They're not sort of totally distinct from each other, but they're conceptually different. Correlation refers to the situation where the same external event creates losses for a large number of important financial institutions. In 2008, that was the housing collapse. It could be something else, and not always come from the financial system itself. It could be a terrorist event, for example. Connectedness comes in two flavors: asset connectedness, where the losses of one financial institution causes losses of other financial institutions in a so-called chain reaction. The other flavor of connectedness is liability connectedness, where the failure of one financial institution endangers the funding of others. For example, if a bank settling tri-party repos were to fail, or if in the crisis J.P. Morgan had been in trouble, that would have created a funding connectedness problem. The third C is contagion, where the actual failure or fear of failure, more importantly, of a financial institution causes short-term creditors to withdraw or withhold funding from financial institutions out of either a lack of information or irrational panic. And there's a big debate in the literature about which of those two it really is. So the book first makes the point that contagion, not connectedness, was the systemic risk problem in 2008. Correlated losses due to falling housing prices set the scene for the crisis of 2008, but it did not by itself lead to a financial panic. Many believe that asset connectedness, not contagion, was the major problem during the U.S. crisis. So the book goes on, probably in much more detail than is necessary, kind of a forensic examination of the Lehman situation, and really explores what the connectedness was with Lehman. And the conclusion is not much. People lost about, at most, a couple of cents from the Reserve Primary Fund, which was really connected to Lehman. But you strain to find any other financial institution that was endangered whatsoever, by the Lehman failure. Now people will bring up AIG. Well, we can't really examine that because AIG didn't fail. But if you do look at sort of the data about AIG and look at the counterparty risks, they weren't that significant. For example, Goldman Sachs would have experienced a maximum 18% loss of capital from its CDS positions with Lehman, which is less than the 25% loan loss secured lending limit for banks. And this does not even take account of the CDSs Goldman had on the AG. There's a lot of literature out there about everybody's connected to everybody. That's true. You know, we have a connected financial system. The issue is the failure of one going to cause the failure of another? That's a very distinct question from the fact that there is connectedness. Okay. So my book then describes the three measures that were deployed during the crisis to stop the contagious run on banks and, importantly, non-banks, one of which was lender of last resort. Now, during the 2008 crisis, the Fed amply discharged its lender of last resort responsibility, to make a pun, on the run. It was doing it on the run, okay, through a variety of means, invented new ways of lending to both the banks and the non-banks. Lower penalty rate, wider access for primary dealers, and a term auction facility were major changes in the way the discount window operated. And a multitude of new facilities were created for non-banks. The supply of liquidity to the financial sector doubled the Fed's balance sheet to $2 trillion by 2009, doubled. Supplying liquidity to the non-bank system provided non-banks with almost a trillion in loans and general market liquidity. And more importantly, the very availability of these facilities, as opposed to the lending itself, also helped stop the run. The fact that these funds were available, even if they weren't being used. Now, actually, the Fed and the taxpayer actually benefited from this lending. Balance sheet expansion generated Fed profits, and thus remittances to the Treasury. For 2008, these remittances were over $40 billion, increasing as a result of the balance sheet expansion. Fed making more money. I estimate that today there is about $7 to $8 trillion in uninsured short-term funding in the United States financial system. 66% of this is in non-banks, okay? Primarily money market funds and broker-dealers. Mostly, I would say you could subtract $1 trillion that's in government money market funds, even though it's short-term, since their treasuries probably wouldn't be running. So you're talking about, closer to $7 trillion. Still a pretty big number. And the ability to lend to these non-banks was essential in the crisis and will be in the future. Recognize that as we increase capital requirements and other things for banks, we are creating even bigger a non-bank system. There's stuff that disintermediates from the banking system into the non-bank sector. So our ability to be a lender of last resort to the non-bank system is really important. Now, during the crisis, the legal authority for the lending to non-banks was under Section 3, still is, of the 13.3, of the Federal Reserve Act, which provided, still does, that in, quote, unusual and exigent circumstances, unquote, the board could authorize a reserve bank to make loans to a non-banks where such loans were, this has been changed, secured to the satisfaction of a Federal Reserve Bank. This authority to loan to non-banks is quite separate from the discount window authority, which was not touched very much. After the fact, the authority that was used in the crisis was widely attacked as bailing out Wall Street. This triggered radical calls for changes in Section 13.3 authority for non-banks. Oddly enough, such concerns did not generally translate to the Fed's use of the discount window, even though in popular talk it's the banks that are getting away with murder, not the non-banks, but that didn't result in any significant change in the discount window, which is how we loan to the banks. So looking at the non-banks, what were the changes? What were the important changes? The first one is that the Fed can only lend to non-banks with the approval of the Secretary of Treasury under procedures adopted in consultation with the Treasury. Now, one can argue with the importance of this restriction. Some point correctly to the fact that Paulson was Bernanke's cheerleader during the crisis. But will all secretaries of treasuries in the new bailout environment be such willing cheerleaders? Treasury approval now would carry significant political risk. It even did then. Remember, Paulson let Lehman fail because he didn't want to be Mr. Bailout. And the markets will know Fed support may not be assured, which itself could trigger or accelerate a run. The use of emergency liquidity assistance for banks and non-banks by the Bank of England, in comparison, does require Treasury approval. And under certain circumstances, the UK Treasury can even direct a bank to make emergency lending. However, any emergency lending undertaken by the Bank of England at the Treasury's direction or approved by the Bank of England by the Treasury when requested by the Treasury carries an indemnity by the Treasury. Thus, the Treasury says, I will make good any losses of the Bank of England. And they have to have the fiscal resources to make good on that promise. Okay. Now, they may not have gotten the appropriations, but it's like a government IOU. Okay, that's a fiscal decision. Such coordination of fiscal and central bank authorities in cases of lending to banks that may be experiencing solvency problems but are not insolvent offers a possible model for us. It's not just getting Treasury approval, which is what we now have. It would be Treasury approval and indemnity. And the indemnity would require a call on the financial resources of the United States. That's a difference. Second, the amendments to 13.3 provide that the Fed can no longer make one-off loans to single beneficiaries, such as it did in 2008 to AIG. It must instead do so under a, quote, broad program. Largely the urging of critics of the Fed adopted a regulation implementing this provision that provides that at least 5 institutions must be, quote, eligible for any Fed program. If this means eligible at the time the Fed provides the first loan to one institution, it may make it harder to nip a contagious run in the bud. You'd have to wait for 5 to need the money, right? If it means ever eligible, okay, there is ever going to be a run, then this is not much of a restriction, and you can just see how the Congress is going to react to that kind of interpretation by the Fed. I would not want to be Scott Alvarez dealing with this problem in the future. Third, DoddFrank required that all loans must be collateralized, and not just, as it was before, to the satisfaction of the Fed, but they all have to be collateralized, and a lendable value has to be assigned to all collateral. No more purchases of unsecured commercial paper, which the Fed did in the crisis. Fourth, the Fed can now only loan to solvent non-bank institutions. Again, a requirement not imposed on lending to banks. Now, a key argument for the solvency requirement is that lending to an insolvent institution should be a fiscal issue, which I'm very sympathetic to. And that is because Fed losses actually could result, they were profitable in the crisis, but Fed losses themselves to an insolvent institution could reduce seigniorage and remittances of the Fed of their profits, as they have to keep those profits to cover their capital. I think this is a very legitimate concern, but we need a better system for dealing with it than we now have. A fifth provision of Dodd-Frank provides for disclosure. Disclosure is always good. Wrong. All loans to non-banks must be reported within 7 days to the chairman of the House and Senate Financial Institution Committees, and then must be disclosed to the public within a year. On the banking side, one change on the window is all discount window loans must now be publicly reported within 2 years, where we didn't require that before the crisis. Concern with such disclosure requirements is that the prospect of disclosure, certainly within 7 days, and even many people in the Fed would say within 2 years, as it is for banks, will discourage borrowers concerned with stigma from seeking needed support and therefore make the problem worse. Okay. How we navigate that, I'm not clear. To me, I'd say 2 years. Okay, we need some disclosure. 7 days? No. 6, Dodd-Frank provides that banks can no longer pass on another change in the window, very significant, can no longer pass on discount window loans to their non-bank affiliates, such as broker-dealers. without being subject to the normal Section 23A limits on inter-affiliate dealing, which they, during the crisis under the old law, were exempt from, so they could pass on all amounts that they borrowed from the window to their affiliated broker-dealers. Now they can't do that. They're subject to caps. This means that substantial borrowing by bank-affiliated broker-dealers, which dominate the broker-dealer world, would have to all now come under 13.3 with these restrictions that we're talking about. Even further restrictions are being seriously considered. The House Financial Reform Package, the Choice Act, provides that the Federal Reserve could only loan to non-banks if at least 9 of the 12 Federal Reserve Bank presidents voted in the affirmative. Further, all federal regulators of the potential borrower, which would often include the SEC or the CFPB, would have to certify in writing that the borrower was not insolvent. What does the CFPB know about this? Okay. All right, so, let alone the SEC. Some conclusions, okay. Contagion is the major systemic risk concern, but DoddFrank focused on protecting us from connectedness while making it harder to deal with contagion. And we will have undoubtedly new contagion episodes in the future. Second, we know how to stop contagion through the use of lender of last resort and guarantees and capital injections, which I don't have time to talk about. If these powers exist and are sensibly deployed in advance, as they were not in 2008, we would not have contagion in the first place. We fought contagion in 2008 on the run. Better system, the weapons are out there before the run ever could happen, and then you don't have the run in the first place. Okay, that's not what we experienced in 2009. What's the way forward? Oh, by the way, I don't think capital, liquidity, or resolution will safe-proof the financial system from contagion. And even if the financial system is better fireproof today, which some of my distinguished colleagues at Harvard don't think is the case, you still need a fire department. Okay? So what is the way forward? Here's what I think we should do. First, have a strong lender of last resort. That means largely restoring the powers to what they were in 2008 and even strengthening them. Second, enhance disclosure of financial institution exposures to limit contagion based on market uncertainty about such exposures. Actually, we had some discussion of that earlier. We probably made some progress on that. While bad news risks fueling contagion, no information may fuel it even more. However, one must recognize that disclosure will always be somewhat out of date. Conditions can rapidly change and never complete, that is disclosure, and worrisome disclosure still could create panic. But on balance, I think we need a better disclosure system as to what the status of bank solvency really is. Third, I've discussed this, have a coordinated fiscal, treasury, and lending Fed approach clearly established in advance. We don't have that. Fourth, have a rule of law requirement for the central bank. A lot of what bothered conservatives during this crisis was not just that the Fed was lending to an insolvent institution like AIG, but it was like making all this stuff up without any framework, no rule of law, total discretion. Okay. So I think it's incumbent upon the Fed, for good policy and good politics, okay, to lay out in advance their approach to being the lender of last resort. Lay out their facilities. Lay out not how they would make a solvency determination, that's really difficult, and you need a lot of discretion. How would they think about it? Okay. A better approach to a broad program. What are they going to do about penalty rates? How are they going to look at collateral? Okay. I think if they put out this kind of framework, it would make it a lot easier for those who want to restore needed power to do so. Ambiguity is not only not constructive, in my view, it is positively harmful. The market should be told, okay, what the approach of the Fed is going to be. And finally, require that those borrowing from the central bank or receiving fiscal support pay a sensible price where appropriate. This price might range from penalty rates to enhanced supervision or replacement of management. Such penalties could deter seeking help, which might make the situation worse, but they are necessary in our society, in my view, to minimize moral hazard and to respond to popular opinion. Thank you.
Thank you, Hal. And so with that, I'm going to ask Chris for her comments. Chris really needs no introduction. She is the first vice president at the New York Fed, and the CEO was the CEO at that time. She has a very, very deep background in research and quantitative analysis, and we're very lucky to have her today for her comments.
Well, thank you very much, and thank you, Hal. I wanted to start out by, of course, thanking Vanderbilt University Law School for hosting us here. But I also wanted to compliment Hal on the book Connectedness and Contagion, which I think has a very interesting structure. It's a pretty comprehensive look at what came out of the crisis. It is done, though, in small, short readings that make well-contained points, and I think would be an excellent starting point for class discussion. Very provocative ideas in some cases, as you just heard, and those are good things to get students to think about. So again, my compliments on, it was an interesting read for me, but I thought even more interesting to try to generate a good discussion around the various points in the book. So I'm going to start from a little bit different place, and that is from this more recent financial stability literature that's developed since the financial crisis. I think there was a literature before, but I'm going to focus on the more recent literature to really talk a little bit in different terms about your contagion issue. And in that literature, there's a description at the beginning of the article that I would recommend to you. It's by Marcus Brunemeyer and two co-authors, Eisenbach and Sanikoff. It's called Macroeconomics and Financial Frictions, and it's basically a survey of literature going back, to the 70s to talk about features that we see in financial crises. The first feature is persistence, and they associate that a lot with the reductions of net worth that occur when there's a shock. And once you see a drop in your net worth, of course, you have to work your way back to where you were before. Usually that takes time, that's persistence. And the second is amplification. That is, what causes crises to be bigger, what amplifies them. And that they particularly point to leverage and liquidity mismatch. And so I think a good part of what you talk about in the book, Hal, which it really is focusing on wholesale funding and the issue that poses, this run phenomenon, is, I think, part of that liquidity mismatch. But just as important, I think, is the leverage side of things in this literature. Amplification comes from the banking system, of course, because it is leveraged, as we heard Simon talk about, but it can also come from the non-bank financial sector, as we all know, and it also can arise in the non-financial sectors. And we've seen that some in Asia, kind of more back in 1998, where there were dislocations in the corporate market or the real estate market, and there has been work by a fellow named Aikman, A-I-K-M-A-N, and co-authors to look at how financial stability indicators actually behave over time, and he and his co-authors would stress that the non-financial sector is really, really important. So let me go back to this amplification. If both leverage and liquidity mismatch are important, I would say perhaps we'd be better off saying that neither capital requirements nor liquidity requirements, or even I would include the kind of discount window thing, neither of them is probably sufficient. And in fact, I think if you look hard at the crisis itself, and look at what was happening in the fall of 2008, the amount of liquidity that had been provided, the TARP, and still you had Citi and B of A that needed additional doses, that it may be the case that even a lot of liquidity and help with leverage might not be enough. And so I'd say, first of all, neither liquidity nor leverage, reduction of leverage, capital, is necessary, is sufficient, but they both may be necessary. That is, they both are vulnerabilities. And so, I'd hope that the capital requirements would get a little bit more weight in your view, Hal. The next point I'd make is related, and that is, I mentioned this work by Aikman, and one of these is a Federal Reserve Board working paper that has spectacular charts at the end, which are ribbon charts, which show, on a heat map basis, how hot a sector or an indicator is, that is how stressful it is, and how cool it is at different points. And that work has been used by Aikman and others to try to talk about how does this financial stability issue or episodes of financial instability actually take place. And it's their belief that the risk appetite indicators, those might be things like asset prices, certain kinds of asset prices, and also lending terms, those things often lead substantially in a period of financial instability by up to 3 years in their view. Their kind of paradigm, which may not be true, but at least it's sort of a hypothesis that's been put forward, is what happens is that the non-financial sectors become more willing to take on risk. As a result of that, the banking sector starts lending into that desire to take on more risk. When the banking system gets essentially full up, the non-bank financial sector takes up the slack and also gets itself fairly overextended. And then you start to see the impact of the crisis and the spiral that occurs because, again, of leverage and liquidity mismatch. So it's a hypothesis. I think it doesn't, that it fits the financial crisis not too badly, but again, something to think about there. And they've done some econometric work that tends to, again, point back to the non-financial sector and the attention that needs to be paid there to leverage and liquidity mismatch. I'm going to stop at that point and just go to two more small points, because again, this book is rich in insights. One is on Cocos and bail-in, and you have a really nice chapter talking about that. And there are a lot of economists, as you may know, banking economists, who are very interested in Cocos, people like Calomiris and Herring and my colleague Joe Hughes. The problem, I think, that we find is that, of course, a Coco is triggered usually by a market price change in advance of any sort of resolution, but the company's in trouble, the price of their stock is dropped, and the Cocos are triggered, so this is convertible debt that then becomes equity. And the challenge is that very often the path being followed by management and the strategy of management is pretty broken. And we certainly saw a fair amount of that in the crisis. And in that case, it's really not clear that the injection of capital is going to be successful. And then the trade-off, the challenge, is that in using up some more of the capacity of the firm, their loss-absorbing capacity, in this effort to kind of restart, that the firm, if it does head towards resolution, ends up with not enough resources to be effectively capitalized. And I would say the logically prior question for all of us is, how do we have a failure, a resolution of a globally active institution? I myself have worked some in this field while I was still at the Fed. working on the resolution planning world, and we've made enormous strides. I worked on studies in the 90s that were talking about how hopeless it was to think about a global resolution, but in fact, we have made enormous progress there, and I'd love to see more academics really dig into all the change that has occurred. Does that mean it's going to be smooth and beautiful and perfect? No, of course not. But at the same time, I do think trying to preserve this option of resolution very important. And of course, as you've heard this morning already, very important for the whole DoddFrank reform, that we can preserve that Title II resolution. Last point I'd make goes back to where you started, Hal, on lender of last resort. And I thought what you said was very, very interesting. And I had thought about a point that I think really touches on what you said. You're have a much more sophisticated approach. But I've spent a lot of time in tabletop exercises and war games and the rest, and it's almost like consistent across all of these that the thing you learn is that communication ends up being absolutely critical. And so I think what you were talking about is having a sophisticated approach to communication. Tell people what you're going to do or what framework you're going to work within beforehand, and then communicate. My own personal interpretation is that some of the anger that Congress has and that the public has is that Congress learned just how bad things were really late. My impression is when TARP was brought to them. That's way too late for them to hear just how much trouble our financial system is in. And similarly, the public, I think, probably never really fully understood what it was that the Fed was doing, the FDIC, all of the rest of us. So again, I just emphasize communication, and I like the structure that you were talking about. Thank you.
Thank you very much, Chris. And so I'd like to ask Morgan, about whom I know exactly nothing, to give his remarks, and we all know Morgan. So
I have slides on this. Hal taught me securities regulation in law school. You probably doesn't remember this, but I had a period in law school where I wasn't so good about going to class. Students, don't close your ears. And Hal, I wouldn't have thought he would have noticed, but it was a big psych reg class, but he sent me an email and said, if you don't start showing up, you're going to get kicked out of class. And so there was a moment I thought Hal might actually be ruining my future, and little did I imagine that I would one day be commenting here on his book. So, all right, so let's see. So there's a lot I could say about this book. It's a masterful book. It's remarkable in its scope. It'll be studied for years to come. In fact, I'd say if you're going to read one book about contagious runs on the financial system, then well, obviously you're going to read where did this come from? If you're going to read two books, one of them should be Hal's. So there's both diagnostic and prescriptive components to the book. I'm going to focus on the prescriptive parts because on the diagnosis, we basically agree. Contagion, not connectedness or other things, was and is the main problem for financial stability policy. I think that's probably right. In fact, I think the weight of the evidence points toward this phenomenon as being far and away the central problem for financial stability policy, at least insofar as what we're concerned with is forestalling acute macroeconomic contractions arising from the financial sector. So I'm not going to say anything more about the diagnostic parts. I'm going to go to the prescriptive stuff. So Hal's prescription is pretty straightforward as he laid it out. It's robust government, lender of last resort, and guarantee powers. He focuses overall somewhat more on the lender of last resort as he did in his comments here, and that's what I'm going to focus on mostly here. And I'm going to offer a critical perspective on this strategy. So Hal doesn't spend as much time as I'd like on costs, challenges, and risks of a robust lender of last resort. This is a massive government intervention. It entails a huge contingent resource commitment, and it would be surprising if it didn't have big ex-ante incentive effects and other side effects. And I'll start with an eminent quote from an eminent observer. Does a serious problem of moral hazard arise whenever there's an effective lender of last resort? The answer is pretty obviously yes. This is Robert Solow, 1982. So Hal does talk about moral hazard in the book. He spends more time on it in relation to guarantees and bailouts than he does in relation to the lender of last resort. And my guess is, and he can correct me if I have him wrong here, my guess is he doesn't think the lender of last resort poses a big moral hazard problem so long as you do it right. And doing it right means lending only against acceptable collateral. He wants it to have a pretty broad range of acceptable collateral, but he wants to apply sensible haircuts, appropriate haircuts based on risk. But it seems to me there's an unavoidable trade-off here. I've argued that in direct proportion to its effectiveness in arresting panics, the lender of last resort generates bad incentive effects and other side effects. So here's a spectrum. This isn't exactly profound, but one way you could do the lender of last resort is to be pretty conservative about it in terms of acceptable collateral and or haircuts applied. But this limits the amount you can lend. So you're at the far left side of this spectrum. And there could be no assurance that the available collateral for individual institutions or for the system as a whole will support enough lending to forestall the contagion that's the whole point of this institution. Now you might say, look, if the government can credibly commit to be conservative, then the financial sector will be too. They will limit their fragile funding to a level commensurate with the liquidity backstop. But there are strong reasons to doubt this. So if you take that argument to its logical conclusion, it implies we should just get rid of the lender of last resort, and that way no financial institution will use fragile funding at all. That's obviously wrong. Of course, this funding model preceded the creation of the lender of last resort, was the reason for the creation of this institution. So this funding model just isn't predicated on a public liquidity backstop. And the point is, if you want the lender of last resort to be reliably effective in safeguarding against contagion, you might need to be more liberal about it. And to the extent you liberalize, you move towards the right end of the spectrum, and you run into moral hazard, which means you encourage more risk-taking, which may in fact increase the likelihood of crises coming back. Also, some have argued, I think convincingly, that moral hazard should be expected to introduce other distortions into the financial system and the broader economy. And specifically, I'm talking here about excessive credit and asset price distortions. Paul Krugman in '98 was writing about the Southeast Asia financial crisis, as Simon was and many others. And he was also looking still at Japan in the late 80s and early 90s. And he developed a model in which the problem of moral hazard in financial intermediaries can lead to overinvestment at the aggregate level and overpricing of assets. Excessive risky lending creates inflation, not of goods, but of asset prices. So it doesn't take too much imagination to apply this lens to the recent crisis. Maybe moral hazard had something to do with the asset price dynamics that we saw in the run-up to the crisis. Now I show here residential and commercial real estate. I've indexed this to 100 at the business cycle trough in 2001, just to show the asset price dynamics in the real estate sector. The reason I include commercial here is a lot of people talk about moral hazard arising from the GSEs and perhaps more broadly from housing policy. That can't be the whole story, right? So the commercial real estate series I'm using here actually excludes apartment buildings, so this is really commercial real estate. We see it pretty similar, in fact, by some measures, in terms of trough to peak to trough, a bigger movement in the commercial area than in the residential area in terms of price movements. And all I'm saying here is we need to at least entertain the idea that robust public backstops, even if they're just liquidity backstops, aren't all that benign. We're putting a big put option behind the markets, and this can have distortive effects. So anyone with even moderately laissez-faire sensibilities, and I think Hal will put himself in that bucket, should be really leery of the lender of last resort, one would think, in the abstract. But this, of course, raises the question, well, it may not be perfect, but do you have any better ideas? Well, it turns out I do have some better ideas. So to no one's surprise, I'm going to talk for a minute about money. Hal studiously avoids attributing monetary significance to the financial sector's short-term debt. He does allude on page 235 briefly to the money premium literature that Sam and co-authors, where'd Sam go? Oh, there he is, have contributed to. But that's certainly not a big theme of Hal's book. But I think there's something to be said for looking at a few of the different contexts in which for a very long time, a lot of different people in a lot of different contexts have attributed monetary significance to the very short end of the yield curve. We can look at, it's a truism, of course, that banks create money, whether that's banknotes in the 19th century or deposit accounts today, right? That's just money in banking 101. But in the accounting context, the term cash equivalent applies to only short-term debt, right? Longer-term securities, no matter how safe or no matter how liquid, aren't eligible to be cash equivalents. You can't group them with your cash on your balance sheet. You have to call them investment securities. And the account chooses a 3-month maturity cutoff. We could talk about central bank monetary aggregates. We could talk about the way securities laws treat and investment company laws treat short-term debt. And in the U.S., there's a 9-month distinction drawn there. Perhaps most obviously for centuries, the market for short-term, high-quality debt has been referred to as the money market, as distinct from the more familiar capital market in which stocks and ordinary bonds are traded. The term euro currency is another example here. In economics, the term near money has been used for a long time by a lot of people. The reason I go through this is just to indicate that there's a wide variety of contexts in which we've recognized this. I'm now going to steal from Sam. I always steal this. Sam's shaking his head because I always steal this from him. So Sam and Jeremy and Robin at Harvard studied the Treasury yield curve, and they took the longer term. So the x-axis here goes out to 25 weeks. So that's a 6-month maturity. And what they did is they took longer-term Treasury yields and they extrapolated them to the short end. They said, what should short-term Treasury yields look like based on an extrapolation of longer-term Treasury yields? And what they found was that short-term yields are a lot lower than one would expect. In other words, investors are getting something besides a pecuniary yield from this, and they refer to this as money services or a convenience yield. It's a non-pecuniary moneyness yield, and they call this the money premium. This too has been, this idea has a long history within economics. Henry Simons, founder of the Chicago School in the 1930s, short-term debts are closely akin to money. Keynes, when in his discussion of liquidity preference in the general theory, in distinguishing between money and bonds, he suggests a 3-month maturity cutoff for what we consider to be money and bonds. So he was saying this. John Hicks, in Value and Capital, builds a short maturity, a very close substitute for money. We have a lot of economists, historically and today, who have said in one way or another, short-term debt is money, at least high-quality short-term debt in the financial sector. So what's at stake? So is this just semantics, right? Am I just Hal doesn't embrace this framing, at least in the book, and a question you could ask is, why does this matter at all? It's just semantics. What's at stake in applying a kind of money view to these markets? I think it's really important that we do so. And I think that I'm just going to spell out, this conclude here, with some ways that I think this is immensely clarifying and can help us organize our thinking about financial stability regulation to begin seeing this as a monetary activity. Money creation has a public dimension. Even most, pick your great adherents to laissez-faire from Milton Friedman on through today, and most of them will concede, well, the monetary framework is something where we really need the government involved. Money creation raises special issues, not just instability, but also questions of monetary control, the conduct of monetary policy, questions of seniorage, which Hal did allude to here today. We can begin to see a banking charter as a monetary outsourcing contract. We can think of this as a procurement arrangement. And we can start then thinking more carefully about what privilege a banking charter conveys. We can ask what a deposit is. What are we restricting entry into exactly when we say a bank needs a charter to have deposit liabilities? Those of you who are, I mean, my students know this, but many of you are not lawyers or have never looked at this probably or less familiar with it. If you look in the U.S. Code for the definition of deposit, deposit is defined as a liability of the bank, and the bank is defined as an entity with deposit liability. So you're in this perfect legal circle, and it doesn't get you anywhere. We've never reached a functional legal specification of what constitutes a monetary instrument. I view this as the central problem for financial stability policy. It's right there at the very core of the operating system. It's not this highfalutin stuff. This is the most basic question that we need, in my view, to be asking. We can start to justify granting bank charters based on public convenience and need once we see this as a monetary outsourcing contract, as opposed to seeing it as intermediation that arises naturally and that we're then imposing regulation. We start seeing the Eurodollar market as an abrogation of monetary sovereignty. We can talk about that later if people want to. We can start to see financial stability as a discrete task of institutional engineering rather than an open-ended search for an amorphous enemy like systemic risk. I find this to be a liberating recognition. We can arguably simplify and scale back some, maybe even many aspects of modern financial stability regulation. By getting this thing right, maybe we can stop trying to do a bunch of other stuff. So to sum up, I think the Money View helps us to organize our thinking about the nature of the problem we're dealing with in financial stability regulation. Financial stability regulation is monetary system design, in my view. Those are not different projects, they're the same project. And they always have been the same project. It's the same problem that we've been dealing with for centuries. So that's my perspective. I'm going to conclude my final slide. I talk a lot about entry restriction into money creation. So when the Bank of England was created in the 1790s, not long thereafter, some other entities started to get into banknote issuance. And what did Parliament do? I'm not going to read the whole thing, but I've underlined the key words here. It shall not be lawful, Parliament said, for any body other than the Bank of England to borrow, owe, or take up any sum or sums of money on their bills or notes payable at demand or at any less time than 6 months. This is a 6-month maturity cutoff for issuance of bills and notes. Now, they excluded trade payables of commercial firms, right? This didn't include accounts payable. This is issuance of bills and notes. And this, to me, this is at the beginnings of the regulation of fractional reserve banking. They kind of sort of got it right here. This is a functional definition.
It's all been downhill since then.
Well, yeah, it's really not gone too well since.
Roll back a cloud.
Not gone too well since then. The story of banking, in many ways, we can think of the history of banking regulation as the history of formalistic attempts to define what privilege we're conveying by a banking charter and ways that the financial sector is sought to get around. So I'll stop there.
Great, thank you, Morgan. And next I'd like to ask Kate to come and give her comments. Kate is a professor of law at Columbia Law School. She's written prolifically in the area of money and banking as well, systemic risk and central banking.
With that limit short-term funding,
Stand here now.
There's no limit to
All right,
how
I'm
much
going to move on
the
to
chart
so
system
hopefully you can
creates.
hear me. All right, so like others, I really enjoyed this book. It is a masterpiece in many regards in terms of the detail that it provides you, no matter how much time you've spent studying some of these issues. Unlike Morgan, I'm not 100% convinced by the diagnostic, so I'm going to spend a little time on that. So I think it also relates very much to the prescription, but I think being a little more flexible in the diagnostic